Can one retirement distribution strategy really be superior to alternative strategies? That's exactly what we're going to explore in today's video. This is part 2 in a two-part series where we break down 5 retirement drawdown strategies. Now, what do I mean by a drawdown strategy? A drawdown strategy explains how you will take from your specific investments each year and how those investments may or may not change over time. In part 1 of this series, we talked through the qualitative side and discussed how these strategies work, as well as the benefits and drawbacks of each strategy. In this video, we're going to dive more into the quantitative side, run some robust analysis, and let the numbers do the talking. Now, I'm not going to re-go over these strategies in depth, so in the upper right-hand corner here, I'll link to part 1. I recommend you pause this video, open that in another tab, and then watch that first if you're not familiar with these distribution strategies. But here are the 5 strategies we've discussed up to this point. In order to break these strategies down further, here's how we're going to run the study in today's video. We're going to use a 62-year-old retiree. In most of these examples, we're going to look at a 30-year retirement, and we'll run a 1,000-trial Monte Carlo. Now, a Monte Carlo is a statistical process where we randomize investment returns in order to create alternative universes and find statistical significance within our results. For stocks, we're going to assume 10% growth with 17% standard deviation, and then for bonds, we're going to assume 5 and 6%. These are close in line with historical estimates. For the sake of simplicity, however, we're going to leave out taxes, but we'll include things like Social Security. Then finally, we're going to score based on the parameters on the screen. That includes the percentage of trials that were successful, as well as many stats relating to the ending portfolio. Now, there's one place that I want to take a side tangent, and that's relating to the way that we look at strategy statistics. Now, know that this tangent is applicable beyond this video as well. On the screen, I have 2 hypothetical strategies, and I'm showing the ending balance of 5 completely made up trials. As a first example, we have what I'm labeling as an uber aggressive retirement strategy. Maybe it entails buying options on darling companies like Tesla or Nvidia. Then on the bottom, I have a boring 60-40 portfolio. Now, many will mistakenly think that looking at the average is illustrative enough when it comes to finance. And in this case, the average that we're looking at would be the average ending balance. And we would see that the average ending balance of the more aggressive strategy is more than twice that of the balanced strategy. But averages are highly skewed in this context, and that's because bad outcomes don't weigh as heavily as incredible outcomes. If your retirement fails, you end up with $0. You can't go negative. So 4 terrible outcomes with 1 incredible outcome will often be 5 reasonable outcomes when we look at the averages. Basically, an incredible outcome lifts up the average. Because of this, it's important to also look at the median results as well. Median is essentially the middle of the sample set if you would order by ending balances. If there is a big gap in value between the median and the average, you know that there's a skew within the data. The incredible outcomes are pulling the averages up. If they are close, the average and median is likely a bit more illustrative. So we're going to include both in today's video. The last quick note before we go into the data, I unfortunately was not able to include the bucket strategy within this Monte Carlo analysis, as I was finding a bug in my code that I couldn't fix before needing to publish and record this video. However, in the last video, I talked through and gave a historical analysis showing the drawbacks of the bucket strategy compared with the pro rata strategy. So I don't believe we are missing material information by leaving this bucket approach out. That being said, I apologize for those that were looking to view this in the context of the other strategies. Then for those interested, on the screen, I have the methodologies I use to build the specifics of each strategy we are about to discuss. For instance, when we talk about a glide path, there's a starting allocation, an ending allocation, and then there's a path to get from A to B. This can be varied, but I did my best to use the most commonly used versions of each strategy. The one strategy that may not be obvious at first is when we look at the safety first approach. What we're going to do here is we're going to use an income annuity to guarantee someone's income based on their income need after they've filed for Social Security. So let's say Social Security covered $40,000 of a $70,000 income need. This strategy involves buying an income annuity to fill that additional $300,000 need at today's payout rates. Now, because the annuity is not inflation adjusted, there is going to be a small gap that continues to grow over time and thus needs to be filled by the remaining portfolio. In addition, the remaining portfolio after the annuity is purchased is invested aggressively in a 90-10 in this given analysis. Now, this brings us to the first of the three breakdowns of our analysis here. In the first example, we're going to use a $1 million portfolio, and this retiree has a goal income of $75,000 per year. Now, we're going to take this number and adjust it for inflation each and every year. This retiree has a $3,000 per month Social Security benefit at full retirement age, but they're going to delay their benefit until age 70. This brings us to the table on the screen. Now, there is a lot of data here, so feel free to pause and look over this table. But because of this, I highlight in red the worst distribution strategy in each category and then highlight the best in green. First, we see that the reverse glide path of starting with extra safety at the start of retirement and then growing our equity allocation as we age gives us the best success probability. And this is going to be a recurring theme. Time segmentation and safety first are close behind. Probability of success, however, is only one variable. Ending portfolio size is of similar importance because the larger the ending portfolio, the more safety you have if you live longer than 30 years. If you care about the next generation and giving to the next generation, ending portfolio matters. And then also if you care about dynamic income, seeing raises in your income throughout your retirement, higher ending portfolios will mean higher spending throughout your retirement in many of these trials. And pretty handily, time segmentation wins out when it comes to ending portfolio balance, with the pro rata method being a close second, followed by the safety first method. One thing that is clear from this table, as well as the tables to come, is that the traditional glide path method is an inferior strategy. Now, this is quite troubling as a massive industry of target date funds is essentially built off this distribution method. Now, as we see from the probability of success scores, this is a moderate scenario where the spending goal relative to the assets is somewhat substantial. Let's move to a point where the spending is more conservative. In this next example, I change both the spending and also have the retiree file for Social Security at their full retirement age. And interestingly enough, we see some of the data start to adjust here as well. First, two things remain consistent. The reverse glide path gives us the highest probability of success, and the traditional target date glide path is equally the worst once again. But beyond that, some of the other data adjusts slightly. Let's first focus on the safety first approach. What's happening here? The larger your portfolio balance is relative to your income need, the more attractive safety first can look. And that's really considering the upside. Well, why is this? Well, if you need 80% of your portfolio to guarantee your income, that doesn't leave much else to continue to grow, leading to a larger ending portfolio. On the flip side, if you can guarantee your portfolio with just 20% of your balance, the rest of the portfolio can stay quite aggressive, which can often lead to really large ending balances. This is why the average is skewed high for the safety first approach. There are certain results where the underlying stock portfolio did incredibly well, thus bringing up that average. You'll also notice at the bottom that I highlight for the safety first approach, the almost run out row. Now, what is that almost run out row? Well, basically, if your ending portfolio was less than 30% of your starting portfolio in inflation adjusted terms, you quote unquote almost ran out of money. Well, the reason this is highlighted in orange is because almost running out doesn't mean the same thing in the safety first approach as it would in, let's say, the pro rata approach. If you run out of money using pro rata, all you have left is Social Security. If you run out of money in the safety first approach, you have Social Security plus your annuity income. And those will both probably be pretty close to your full goal. And so it means something completely different in the context of an unsuccessful trial. And so as we zoom back out on this chart, there are two additional takeaways. First, once again, the time segmentation is consistent and showing solid results across the board. Second, we see the power of a distribution strategy is somewhat correlated to the income to asset ratio that you have. The more conservative this spending, the more attractive certain approaches can become. With our last scenario then, we're going to once again change two key variables for explanatory purposes. We're going to shift the retirement time horizon to only 25 years instead of 30. And then we're also going to use the retirement spending smile as our income path rather than just simply inflation adjusting each and every year. Because of this, we can afford a higher starting income of $80,000. Again, we see that the reverse glide path delivers the highest probability of success in all three of these scenarios. Time segmentation, once again, delivers the best ending portfolio while maintaining a very high probability of success. And then the traditional glide path is close to being the worst, but does slightly better than previously. Let's break down a bit why. The shorter your retirement, the worse the safety first approach will do because the income annuity allocation isn't as valuable. The upside of an income annuity is longevity protection. When you don't have longevity, that protection is underused. On the flip side, a traditional glide path will do better because the shift to safety as you age is stopped prematurely, therefore making up for any longevity issues associated with the traditional glide path. So now let's start to consolidate some of the takeaways from the study in hopes of giving additional data that may not readily show up in the summary statistics. First, I think the traditional glide path is quite clearly the more inferior strategy, at least with the studies that we ran. And on the opposite side of the spectrum, I believe that time segmentation and reverse glide path are the best based on what you are solving for. Surprising to many may be the strength of the safety first approach. Many will look at income annuities as an expensive way to gain certainty in retirement. But we can see that depending on what you are doing with the remaining portfolio in the safety first approach, growth can be quite competitive to the other strategies. The pro rata approach, in my opinion, although ranked slightly lower, at least on this timeline, is a solid strategy if you are aiming for simple. It consistently ranked right in the middle of the road, and also know that pro rata generally looks better in a real world environment because growth often follows losses in the real world. In a Monte Carlo environment, each year of performance is independent of the previous year of performance. The second takeaway, the length of your retirement, is an important factor, as we've already discussed. A safety-first approach is weaker on a shorter timeline, whereas a traditional glide path is going to be a lot weaker on a longer time horizon. So taking into account your family longevity, retirement date, and current health is important for deciding the best strategy for you. Another important variable, as noted earlier, is that the income to asset ratio matters. Said in a different way, the size of your withdrawal rate matters. A more aggressive withdrawal rate may rule out a safety first approach because it is difficult to guarantee your income and still keep pace with inflation with the remaining portfolio. For instance, if it took your entire portfolio to guarantee your income, that would leave a lot to be desired over the long term. Time segmentation is fairly robust up to moderate levels, but at riskier levels can once again be difficult to liability match and still have a sizable enough growth portfolio to overcome inflation over time. On the opposite side of the spectrum, safety first and time segmentation do quite well with those with lower withdrawal rates. Then finally, I'm going to rapid fire a couple notable points at you. When we discuss the safety first approach, if you take the remaining portfolio and invest in, let's say, a 60-40, benefits of this safety first approach will completely break down. Strong results are dependent on a high growth allocation, and this makes sense. As we've shown, solving for different goals can change the optimal strategy for your situation. If your goal was to maximize probability of success, frequently the reverse glide path would be the best choice. This would not be the case if you were solving for, let's say, the largest legacy. Third, I hope you find this analysis helpful, but understand that changing certain parameters can change the outcome. If you thought bonds were going to earn an expected return of, let's say, 1% versus the 5% randomized in this study, you would see different outcomes across the board. You might also see different outcomes if we add additional asset classes. Fourth, investor behavior and the stick-to-itiveness of the approach is most important. A great plan that is abandoned loses to a mediocre plan that is stuck with. Always keep this in mind. Then finally, another variable unexplored in this video is dynamic income. If you're someone who wants to quote unquote die with zero, you will want an income plan that adjusts as your balances adjust. Better growth means more spending in this case. This is not illustrated here, but is a fascinating variable I plan to explore and fold into this analysis at some point in the future. Now, one thing that we didn't cover in this video was the tax side of retirement. For many retirees, taxes will be your largest expense. And therefore, if we can save on taxes, we too can use this to improve our retirement distribution strategy. Here is a video where I walk through a framework that you can use to make better tax decisions on an annual basis. Thanks for watching, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.